All right, everybody, welcome back. This is Signet with the Bullish Bears, and tonight we're going to do a deep dive into ZM. This is Zoom Video Communications. The company's been around for quite a while, but not under this ticker symbol, which is why I have data down here from 2017, 2018, 19, and the current year 2020, but the chart only goes back into last year 2019. So I just wanted to point that out right away. This is an information technology sector company. The industry is application software. It's ranked number 27 out of 131. It has a quant rating with an F in it. This is the first video that I've done with a company that has an F anywhere in the quant score, and it comes from the value of the company itself. This thing is way, way overextended. Having said that, there is no limit on how far a market can run. I know that we have this assumption that a market just can't go any higher, and we all want to play the contrarian trader, but we also have to remember that there is a part of the marketplace that focuses on companies that are moving and doing really good, and that it's kind of the phrase, a strong market will continue to be strong, right? So when we see companies getting to all-time highs, half of the people out there say it's a good time to add more, right? That a strong market or a company that's doing good is just going to continue to do good. And they're right about 50% of the time. And then there's the other group of traders who say, "Oh, it's at all-time highs. People are going to bail out and it's a good time to short it." And those people are right about 50% of the time. The good thing about these deep dive videos is we're not trying to trade it. We're trying to determine if this is something that we should add to a portfolio for long-term growth. And for me personally, every long-term growth trade that I've been taking is with an expectation that the market can double. That's really been my target on every acquisition in my portfolio, is I'm looking for 100%, at least 100% account growth for company growth, I mean. Zoom does not fit that. One thing that I want to point out is that it is considered completely overvalued. The fair value as of September 26 estimates at around $296, and we're near $496. We're not there yet. We're near, and I say that so that we can just do easy math. We're almost $200 above its fair market value. That came from the CFRA's proprietary quantitative model. Okay, that's not my model. It's not my number or statistics. It's CFRA's number. And a lot of my research and a lot of what I do comes from their data. So I just want to point that out there. While I will point out and say that, yes, this is their data, look at this analyst here. Keith Snyder is a big name in the business. In July, he wrote that while we expect ZM to continue growing, we believe the strong results during the April quarter represents a, quote, pull forward of sales, which would have been spread out over many quarters, and that the demand surge created by the pandemic lockdown orders have run their course. Our sell opinion reflects our view that ZM shares have gotten ahead of themselves, with the price almost tripling year to date as investors pile into any company expected to benefit from the COVID-19 outbreak. Now, what he's saying here is, as an analyst, they had already projected how much ZM would grow with its subscriber base and its company model, and how much they could afford to grow. Because while we all want a company to grow, it has to spend money to do that. All right. So his analysis back in July during that red week was that this is a market that you should be selling, that it's done, it's overcooked, and that it had grown too fast, too quickly, and had already outstripped all of its projected growth. And you can see that within a little over a month, it began to skyrocket again and doubled in value from that. It went from $250 to over $500. Okay. So these analysts, they're just people like everybody else, and they are only offering you their unvarnished opinion of what they think a market can do. They're not using anything that you couldn't use on your own. Okay, they're crunching the numbers and they're doing the math and they're looking at supply chains and they're looking at who's running the company. They're looking at subscriber base and the widget and anything that has to do with this company. So these analysts, obviously, they're not going to get it right all the time. So with this quote fair market value, I have to point it out because it's important to recognize that that is there. But this thing could double again for all I know, right? The risks in trying to buy a part of this company with an expectation of growth is that there is heightened competition right now. There are higher than expected costs associated with expanding capacity, and there are lower than expected conversion of free trials to paying customers. So those three things right now are weighing down on ZM. In the cyan colored boxes up there, you'll see that we expect subscriptions sold to new customers represent between 60 and 70% growth in fiscal 21, with the remainder coming from existing clients. Okay, that expectation of subscriptions is a big deal. Keep your eye on any kind of news, reports, studies, anything that comes out, no matter how vague it may seem, that has anything to do with subscribers for ZM. And the other box, we expect Zoom will aggressively expand its presence in international markets, and they expect those markets to grow faster than in the Americans. One thing I want to point out is I personally run a coaching service and I deal with clients from around the world. I deal with young clients and older clients. I use Zoom in my coaching because people can use it. Some of my clients struggle just to, operate their computers effectively enough to trade, let alone to deal with a high-end product like a complicated video conferencing tool. Zoom is not a complicated video processing tool. So I use it. I used to use other products. There's no reason to name them, but they struggled back in March and February to be effective, and they were pricey. This is easy to use and not as pricey, and it works for me. So I'm sure I'm not the only one. Zoom's competitors are all larger companies and they are all better capitalized, including Cisco Systems, Microsoft, and Google. Zoom generates revenue from the sale of its subscriptions to its video communications platform. The subscription revenue is driven primarily by the number of paid hosts, as well as purchases of additional products. All right, so they need to keep the subscriber base growing if they're going to grow. They need to expand into countries that they are not yet in, and they need access to a large pool of people that they can market their product to. So until we see them expanding in either into a new branch, industry, sector, company, product base, or into another country where they can get a foothold into a whole new realm of people to market to, that's going to be a big deal. It's going to be a big problem. So these numbers up here, the anticipated growth for 2021, I think that that's aggressive. We are slipping already back into lockdown in certain areas. I just read tonight, this is October 4, 2020, and I read tonight that New York's looking on going back into lockdown because their COVID-19 tests have crossed the 3% level for 7 straight days, and they're looking to shut down restaurants and schools. So lockdowns are coming back into an effect, and with that in focus, the idea that Zoom could continue to grow is a real possibility. If they are able to lock down institutions like a couple of schools or school districts, maybe some government infrastructure like say Chicago or New York or a very large industrial complex, to where they could be on the hook for a contract for years. That kind of subscriber base would be absolutely amazing, but I've not seen anything to suggest that at all. A couple of school districts have been picking it up, but it's just not enough. Also, projected sales growth of 248% in fiscal year 21, and a 26% increase in fiscal year 22, following an 88% growth in the year 2020. They expect gross profit margin to be between 71 and 73% in 21 and 22, down from 81% in 2020. So you've got a lot to think about here. This definitely has the room to expand because of with the lockdown, more people could be looking to run their businesses from home, right? So they have that going for them. But that's all they have. And I got to keep circling back to that. Other than the lockdown, and that's all they've got. Now you take something like the competitors, Cisco Systems, Microsoft, Google. With Google and Microsoft, if you buy their product, you also get a product like Zoom built into it. Microsoft Teams has this, and Google has this, but you also get everything else. Okay? So when you think about it from that point of view, unless Zoom picks up something else to offer its client base, if it doesn't start finding alternative revenue sources, I don't see how this thing can continue to grow and double from its $500 price tag. I do want to point out that there's a difference between trading this thing and investing in this thing. Okay? As a trader, I would be totally excited to get a hold of this kind of momentum. As a person who would be looking to put it in their portfolio, I wouldn't want anything to do with it. It's too much of a coin toss. There's nothing else here. So I'm going to personally give this a pass, that I'm not interested in putting this in my portfolio. But it does have the potential for growth. Okay, I can't stress that enough. They just got into profitable numbers. All right, so in 2019, that's when the company changed its symbol. And I honestly don't know if that's why this is flat that year or not. But it was negative at minus 20, and then it was minus 11, flat, and then it's at 9. And from 9, we're looking at going to 249. That's a major shift. Okay, that's absolutely staggering numbers. I'm not trying to take anything away from those numbers and say that this could not continue to grow. But there's just too many unknowns. It's too new. They don't have any other sources that I found. And I'm personally going to take it a pass. So my personal consensus here down at the end, this isn't from other analysts, this is my own. If you do not already have exposure to this industry and you're looking to add a company with strong fundamentals and large expectation of forward growth, this may not be the company for you. There is massive risk here for the company that only offers a single platform tool compared to the competition, such as Google and Microsoft, who both offer this service free with a bundle of their other services. So my own personal recommendation is, unless you've got a very large portfolio and you're just looking to add a strong company, you wouldn't want to add this. Okay, I understand people with large portfolios, they've got a lot of work in front of them trying to put that cash to work so that they can get off of the sidelines and get into the game. Perhaps this would be something for you, but if you're running in a smaller portfolio and you're focusing on things that aren't so risky, this wouldn't be one to focus on. Guys, I appreciate your time, and I look forward to seeing you at the next video.